Okay, welcome to the first recording for Chapter 12. This chapter is on deferred compensation and non-qualified plans. We're going to be doing, again, more shorter recordings per chapter so that we can break it up into more manageable sections. The first section that we're going to talk about is going to take us up through slide 16. This is going to be a recap of things that we talked about, I believe, on the first day of class when we talked about the different kinds of plans we had: qualified plans, qualified-like plans, personal tax advantage plans, and non-qualified plans. And we talked about what made qualified plans different than non-qualified plans. It's this sort of special treatment, and we're going to revisit that now because we're going to see how non-qualified plans are different and how they're treated differently by the tax code. And so we're going to get into that again. And I think we've covered most of these things already, but this is just a good refresher before we get into the rest of the chapter. So. We're going to go ahead and get started. All right. So the reason that we offer deferred compensation plans is because we can target who we're going to offer benefits to. We can actually be discriminatory. One of the things that was special about qualified and qualified-like plans is that they had to be for the rank-and-file employees. Deferred compensation or non-qualified plans, because they don't receive this special tax treatment, they are allowed to be targeted toward high-income, typically high-income people, meaning that they can be discriminatory. So the justification for being able to provide these at all is because qualified plans, because we can't consider income above $265,000 for very highly compensated people. The qualified plans are not going to be able to replace enough of their income because they're not going to be able to accumulate enough funds. In a DC type plan or in a DB type plan, they're not going to be able to get to garner enough income. So, as we alluded to, the non-qualified plans don't have the same types of tax advantage that qualified plans do, and we'll get into the details of that here in the next 10 slides or so. So you do have the deferral of income taxes by the executive. So the employee does not recognize receiving the income. Just like in a qualified plan, you get the employee gets the tax deduction. But unlike qualified plans and qualified-like plans, there's no mismatch of the tax deduction and taxable income. So the employer, even though they may have already set funds aside for the employee, they don't get to take the tax deduction now. They only get to take the tax deduction when there is what is known as constructive receipt. And generally, the employer must have substantial risk of forfeiture and must not have constructive receipt of the funds. If you have constructive receipt, generally you don't have. Generally, there's not substantial risk of forfeiture. So if one of those two things is the case, then you don't have constructive receipt. Therefore, that is why the employee does not pay the taxes. Now, in a qualified plan, just to remind you, there is actually constructive receipt often because and it's current because you those funds are yours. You can withdraw them often. Now there may be some penalties on that, but it's your money, and you can withdraw it. And it is set aside in a trust account for you. That money is your money. So that means that you have received the economic benefit of that money. And so we'll see that in a later slide. So the reason that we use these types of non-qualified arrangements, deferred compensation arrangements, is to increase the executive's wage replacement ratio, as we referenced. To defer the executive's compensation, when an executive is in the working years, they are almost always we're talking about people who are earning above the $265,000 amount typically. They are going to be very likely going to be in the highest income tax bracket, and they may not be after they retire. So it may make sense for them to defer paying the taxes on that money until the time when they're in the lower income tax bracket. And also it can be in lieu of qualified plans, or in lieu of means in place of. Maybe they participate in qualified plans, but on top of qualified plans in order to get the full wage replacement ratio. So just explaining this, typical rule of thumb, as we talked about, this is, I don't like using rules of thumb for financial planners, but most people need about 70 to 80% of their pre-retirement income during retirement. And for people who are making up to that 265 or maybe a little bit above, qualified plans can be used to achieve the bulk of that 70 to 80% wage replacement ratio. But when you're making multiples of that 265,000 and you're not able to save on your income above 265,000 or be rewarded by your employer in the retirement account above that 265,000, then that's when you can potentially have a problem. So these non-qualified plans are retirement plans for the wealthy, for people who are the very high income earners. As we mentioned, the executive tax benefits. The employer, there's a rule for publicly traded companies, section I think 162M, that the CEO and other key executives cannot receive, the employer, the company, cannot deduct compensation in excess of $1 million. Now, if that money is tied to anything related to performance, which would mean that there is some risk of forfeiture, then that money is not considered. Then that money is not considered toward the $1 million limit. So CEOs of very large publicly traded companies typically have total compensation packages far in excess of $1 million, but we'll see that often their base salaries, what they receive, is often $1 million or less. So, and then there's as we said, there's an alternatives to qualified plans. So income tax issues. When you defer the income, so if there's no constructive receipt, in other words, it's not set aside for you in a trust account that you could actually get to if you wanted to, that would be constructive receipt. and or if there's substantial risk of forfeiture present, if it is subject to the creditors of the employer, or if it has a vesting schedule attached to it. In other words, if I have to be there at the employer for a certain period of time, and the economic benefit doctrine. Economic benefit doctrine means that if I have access to the economic benefit, then it's there. It's very similar to constructive receipt, and we'll get into that. IRC Section 83 means that we'll actually, I don't want to get too far ahead of myself. IRC Section 83 is a code that talks about what is considered compensation that is taxable, and we'll get into that in a minute. Then there's payroll tax issues and employer income tax deduction. Constructive receipt occurs when funds are set aside for the taxpayer, for the employee, credited to the employee's account, or made available so that he may draw upon them at any time. Income is constructively received if the receipt of funds is not subject to limitations or restrictions. So now we could think that a vesting schedule in a qualified plan might mean that there would be subject to limitations and restrictions. But in a qualified plan, so that may be true. So you might not have constructive receipt immediately in an employer-funded profit-sharing plan. But in the qualified plan, the employer goes ahead and gets that deduction now. And then once you meet the vesting schedule, then according to this economic benefit doctrine, that you would have to go ahead and pay the taxes, which you do not. So, which is different here. Again, both of those are treated differently than a non-qualified plan. Examples of constructive receipt. Obviously, when you get it, when you get a check or you get cash, that's money. You've constructively received it. If you've got things that are basically as good as cash, like matured interest coupon payments, we hardly see that stuff anymore. But the bonds used to actually have coupons on them that could be turned in for cash. That is something that is effective. Just because you haven't cashed it doesn't mean that it couldn't be cashed. So that would be considered constructive receipt. Dividends, subject to the demand of the shareholder. If you can get the money, it's there. Check in the mailbox. That's constructively received. Lots of times people play games with us and say, oh, why don't you pay me next year for that, because I want to recognize it on next year's income tax rather than this year's income tax, things like that. And then so what are we trying to do? Deferred compensation plans, they're structured to avoid constructive receipt by their very nature, because we're trying to defer the compensation. If we had the constructive receipt, we couldn't defer. This is unlike qualified plans. We might have the constructive receipt, like in a 401k, we defer our own compensation, but we still get defer our compensation, but we still get to defer the income taxes, even though we've constructively received. Here we have to avoid constructive receipt in order to get that deferral of tax treatment. So another concept is substantial risk of forfeiture. So it occurs when rights in a transferred property are conditioned directly or indirectly upon some future occurrence. So when there is substantial risk of forfeiture, there are no income tax consequences to the employee, and the employer does not get to deduct it. When there's no substantial risk of forfeiture and there's constructive receipt, income must be currently recognized as taxable. So we'll see how that plays out in a minute. So here's So in a contractual deferred compensation, so this would be considered an unfunded plan where the employer says, I'll put the money in there for you, but I'm not doing it now. It's not in the holding account there for you. Just trust me, I'll do it later. That the employee bears the risk that the employer might, not be able to do it or just won't do it. So you can sue them, but contractual deferred compensation where it's not done by a funded account. So economic benefit doctrine, we've talked about this before. These are all tax concepts, by the way. The employee will be taxed on funds or property set aside for the employee. Funds are unrestricted and non-forfeitable. Very similar to the doctrine of constructive receipt. So, told you we would get to IRC Section 83. So, what is considered taxable income? So, if I am basically an employer cannot make a gift to an employee. Can't say, hey, I'm going to give you something of value, and it's not without it being taxable to, with some exceptions, and we'll get to those exceptions in Chapter 13 when we talk about fringe benefits. But for the most part, an employer can't give an employee anything of value without that being considered earned income. So, if property is transferred to an employee in connection with the performance of services, it is taxable to the extent the fair market value of the property is greater than the amount paid by the employee. Or if I paid more, if I'm the employer and you're the employee, if I paid more for it than you did. So that's similar to fair market value. So if I'm transferring something to you. So here's an example which we will get to more detail about this example later in the chapter. If an employer gives an employee stock with fair market value of 10, but only charges the employee $3, then the gift that has been made, the economic value transfer that's been made is $7, and that's taxable as ordinary income for the employee. So, when is payroll tax due? So, it's subject to deferred compensation is subject to payroll taxes at time the money is earned, at time the services are rendered, except when there is risk of forfeiture. When there's risk of forfeiture, then the deferred compensation is not due. I mean, the payroll taxes are not due until the risk of forfeiture expires. So typically, this will not affect the 6.2% OASDI tax. This will only affect the Medicare tax, which is 1.45%, and the additional Medicare tax above the $200,000 or $250,000 threshold, which we saw at the beginning of Chapter 11. So here, executives with salaries greater than the Social Security wage base typically are the only people who defer compensation in these plans. And then ordinary income at the time deferred compensation is paid out to the executive. So the employer income tax deduction, the employer gets the deduction at the time, matching of income and expense provision at the time that the employee has to pay the income tax. So the employer has, when the employee recognizes that income, recognizes and has to pay the taxes. So when we say the general rule is that payroll taxes are currently deductible, except when there is substantial risk of forfeiture, and then they're only deductible when the risk of forfeiture expires. Okay, so we're going to take a break here, and we're going to go to a new recording. So that wraps up the introduction to remind you of the tax consequences of non-qualified deferred compensation plans, non-qualified retirement plans versus the qualified and qualified-like types of retirement plans.